Dale. Ira Epstein of Linn and Associates with your metals market wrap-up, and this is for Tuesday, the 16th of April, 2019, just after 2:30 p.m. Central Daylight Time. So we have a week that you have to put into perspective. It's Good Friday week, which means we're not open on Good Friday. A lot of traders will take off on Thursday. Some of the markets, actually, I was on the trading floor doing a Fox show just moments ago, and they've got the big signs up. Some markets will trade to their normal time on Thursday. Others are going to close a bit early. So keep that in the back of your mind. Stock market just had a nice rally on it, gave up some of it, but Qualcomm and Apple apparently have reached the end of a battle, and that's a good thing. As you look at the metal markets, you can see the gold market's fighting a trip that's no good. I was on TikTok yesterday, and I was asked about the old rules of inflation. If you go to TikTok on Bloomberg, pay attention to it. What I said there was gold is having a battle because there's no money in the gold right now. What's fighting the gold? The stock market, obviously. You know, at first traders thought that come Christmas Eve when the market bottomed, you'd get a rally and it would get a Fibonacci count and stall. It hasn't happened. It's gone through just about all those counts to new highs. Number two, interest rates. You're back up to a 2.6 interest rate, so you've got to think about that and what it does to the dollar. It gives it a small prop, and that works against the gold. Gold just doesn't have a story going for it. And as you take a look, while the market did pause just a couple weeks ago, right above the 18-week average of closes, that was March 29th, it then broke under it on the week of April 12th, kept breaking out on the 19th, and here we are right now. We're not done for the week, obviously, so I can't tell you where it's going to close, but it's now a heck of a stretch to the downside. Making matters worse, today's action on the chart, you could have argued, and I was arguing, that the potential was here. Maybe this is going to be a support zone. The market sliced right through it today. And as you take a look, the market doesn't look very good there. The pattern is also bearish. For the first time in a while now, with this action, we have lower highs, lower lows. That is certainly what I define as a downtrend. You'd have to take out 12.9910 to break that pattern. And if you did it with just a rally from here, it still wouldn't be an uptrend. You'd have a lower low and a higher high. Then I start looking at what the moving averages are doing. And what the moving averages are is they're converging. So you've got the 18-day average making a run right now, very slowly, but making a run for the 100-day. Now, if you get a crossover, and it is when the shorter term average, the 18, would close underneath the 100, that'd be called a bearish crossover. That's often accompanied by pressure on the market. Number two, where did the market go and stop today? The Bollinger Band. So we've seen this story before, where you go to Bollinger tops or bottoms and then you get a bounce. I have no reason to expect this is any different. So I think the pros today took some money off the table on the first challenge of that number. The market is oversold, so it fits in, but that's not reason to be bullish. There's a big difference between them taking some money off the table, be it to the upside or downside, and reversing the trend. Now, admittedly, you had a nice break from there. From this low when you hit here, you came back pretty nicely. I have no reason to think you can't get another rally, but on the next rally, what bothers me is that 18-day average is going to keep getting closer and closer now to that 100. In the GLD, the popular ETF, same thing. If we come to yesterday, it was the 100-day average that had been stopping the markets. You had this one probe back at the lower Bollinger Band and the 100. Today you went through it, back down. So the trend down, the bias down, oversold, but resistance probably back at the 100-day average of closes. Then we get to GDX, which is being pulled with everything else, has not hit the lower Bollinger Band. Got to go all the way back to the beginning of March. So what I think the smart money's doing is they may not be waiting for this exact part there. They might be peeling parts of their shorts off. Why do I say shorts? Because the trend is down, even without today. Lower highs, lower lows. So if it comes down, this is the area of the support. Notice how the Bollinger Band's running away from the price. Probably get very close to that 100-day average tomorrow if it wants to hit that. Even if you rally back over the recent high of 22.39, so what? You don't turn the trend up, you just negate the bear trend. The gold-silver ratio suddenly coming alive, where right now, look at the lowest close we recently had was 85.56. Right now we're at 85.54. So suddenly this puts silver gaining back on the gold market, and while the trend is down, you can see that it's not plunging to the new low like the gold did, but it's certainly nothing bullish about this chart. You've got lower highs, lower lows. It is oversold. If it were to take out 1506.50, the downtrend as I define it would end, but that would not start an uptrend. You'd still have a lower low and a higher high if it were to just go up tomorrow. In the copper market, I think I've been very clear where it's just sort of stuck. In fact, it got itself stuck between the upper Bollinger Band and the 18-day average, and so far doesn't seem to want to come out of it. We had two fake attacks trying to, and tomorrow could be another one, but it hasn't carried. Now, if tomorrow the market were to take out this last break low and close under the 18-day average, you would have the lower highs, lower lows in place. If you were to take out this high right here of 289.30, you negate the downtrend. You'd have higher lows, higher highs right into the upper Bollinger Band in the 297 area. You're just sort of drifting and not going anywhere. In the platinum market, you're making your run for the 18-day average of support. Remember how often we talk about it? It's from the 18-day average, the red line, that the market gets back to what I call a neutral area, tries to figure out what to do. It has had the trend down in the terms of lower highs, lower lows, but the bias has been up because it's been over the 18-day average. It is working off, current tense, an overbought condition. And the palladium market, I'm looking for the support, and I think I said this yesterday, against the 100-day average, because that seems to be acting better than the Bollinger Band. You always pay attention to which number's closer. That's what it's trying to do. Is there anything bullish on this chart? Other than it being oversold, no. So even if it got up over the most recent high recently of, 1373, you'd still have a lower low, higher high pattern. Nothing to get excited about. And the dollar, well, for 3 days in a row now, it's been playing at the 18-day average of closes. It's got all kinds of divergence. Why? While the trend is down with lower highs, lower lows, the market's trying to settle over the 18-day average, so that gives it upside bias, fighting a downtrend, and momentum pointing down. Let's just call the market fighting on all fronts and not able to decide what it wants to do. That puts into play often the in and out trade of what's called pivot points. And pivot points are not meant, the way that I teach them at least, to carry over from day to day. The idea is you're coming in, using them to maneuver around the market during the day, and you're trying to go home with no position. That's at least the way that I was taught them, the way that I believe in them. You get a neutral number, and it's all made up from the day's high, low, and close. You put them together, you divide, and you subtract one from the other. And I teach it in my first video, so you get the exact formula. Then from there, you plot it. And any good charting service is going to have pivot points on it. From the pivot points, you color them so you can easily see them. And then what I do is I not only take the pivot point, but I tie momentum into it with the short-term oscillator, the slow stochastic. And I teach you how to use overbought, oversold as they're going back and forth, and teach my philosophy of it. It's all that I can do. I cannot tell you you're going to have winning trades or losing trades. It's the philosophy of it. But if you're looking for those in-out vehicles, this should be in your toolbox. That's the best way to phrase it. Give us a call. You can go to our website at www.iraepstein.com. You'll see a carousel of free offers. Click on it. That'll be there. You can click up here if you see me on YouTube, and you will be able to go right to that page instantly as well. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.